Good morning, everyone, and welcome back to another episode of Trade with Conviction. I'm Felipe Elink Schuurman, your host today, and together with me I have Jay Maroo and Neil. Hey guys, how are you?
Good, thank
The
you. Could be
concept.
better after the football. Only Englishman in the room is probably the worst person to ask first, but yeah, let's get that out of the way and then move away from football while we can.
Yes, terribly sorry about yesterday's result. I actually thought about wearing my Spanish t-shirt today. I thought it was provocative, so I decided not to. But yeah, terribly sorry. What a shame. Again, I think that Tuchel was a bit too conservative and put too many defenders too soon. And yeah, it's a shame.
Fully agree.
Exciting
I was,
final. Exciting. Well, maybe you get a chance to beat the French, maybe that boosts your morale on Saturday.
yeah, no one wanted a third place playoff, right? But yeah, with the consolation, sure, we'll take it. But
Yeah.
definitely supporting Spain in the final.
It's funny because these World Cups they seem like forever. They last for like a month and a half. But when you get to the final, it's like it happens so quickly. You get used to it and you actually want to watch more games. But yeah. Anyway, we're getting to the end. I hope you're all rooting for Spain. That is obviously not the news that we're going to talk about today, although I see it's top of mind, and that maybe comes back to what I was talking to you guys again. About everyone is so tired about talking about Hormuz, but we'll get into that in a second. No, obviously we are at this deadlock situation. The ceasefire is officially over, and the escalation is back. Brent is now at 85. It was 72 last week. Neil, can you give us a quick rundown of what's the situation right now?
I can. I'll try and be quick because I think most people kind of know, but maybe it sets the basis for our discussion. So, in essence, the MOU looks to be completely dead now, right? Sort of the statements that we've seen from the last 72 hours, I would say, are very grim from both sides. You were just sort of agreeing with this, Felipe, that it seems like any goodwill that existed before has now gone, and the statements that are coming out from the Trump camp are quite aggressive and worrying. And the Iranians are also basically saying they've got no plans to get back to the negotiating table. So That's quite a change from what we first... I mean, it sounds a bit like the first couple of weeks of when this whole thing started, but we're several months on when we've lost a lot of the oil supply that we could draw upon to solve this thing.
Yeah, it feels like you're back to square one, but with a very different square one. The very different supply scenario. But in terms of the diplomatic environment, it's back to square one, or even worse, because there's mistrust of anything. But yeah, sorry, I interrupted you.
No, it's fine. I mean, it's good to discuss it. I mean, I think if you sort of recall what we were talking about in the previous pods, there was always this feeling amongst most people that it's like an unstoppable force and immovable object. Like Iran, you could see Iran was losing its leverage in the Strait, and I feel like the notion that Iran couldn't let that happen for too long has now been sort of proven, right? They're trying to wrestle back control because they viewed the MOU as, this is US's chance to sort of sneak in a control of the Strait via Oman. And on the US side, remember we got that very overt statement from JD Vance on this talk show a week ago. And it basically just said, we're using this period to relieve tension on oil, and then we'll see what happens after that. So it seems like nobody's really was ever taking the MOU seriously. A lot of the negotiating points were never addressed, and now we're back to complete square one. And we're not in all-out conflict, but we're close to it, right? We even had attacks on some infrastructure. There was a drone that targeted some offshore drilling in Kuwait, and of course, lots of vessels being attacked, generally speaking, right? Jay, what's happening on Bahrain? You were thinking there's lots of attacks on Bahrain in the last few days.
Yeah, so actually my father-in-law was in Bahrain. He was saying that there were sirens heard for the first time in quite some time. So definitely the risk has stepped up. Yeah, we've seen attacks on Kuwait, we've seen attacks on Bahrain. And I think it's also worth noting that the attacks on the two UAE shuttle tankers is interesting because while I've been here, things have been relatively quiet for quite some time. But I don't think we should take it for granted anymore. I think the UAE was obviously bearing the brunt of the missiles for quite some time, and then we've had a period of quiet now. But I think that's really under threat given the way things are shaping up right now.
Yeah, so you see UAE oil production was 4 million barrels per day last month. That's basically the highest they've ever achieved. And they were doing that with flows out of Fujairah plus all the STS activity. And so if you think of the UAE flows as being one of the solvers that we had over the last 3 months, that's now in doubt again because the Iranians are saying, we're going to widen this war. They were saying that this morning. And they're starting to attack the STS shuttles. So it looks like UAE flows are under threat again for the sort of September, October loading period. Plus, there's I would say it sounds like the threat to the Red Sea route and probably to Yanbu port as a port in itself is higher than it has been through this whole conflict, because the Houthis are getting active again. It seems like I'm not saying it's going to happen, but it seems like the threat is the highest it's been throughout this whole period. So it's quite concerning, really.
Yeah, and I think it's interesting you mention Yanbu, because it's, especially right now, given what's happened with the Russian diesel ban for the West of Suez market, Yanbu is more important now than it has been in a long time. So it's almost like a double whammy effect, where Yanbu is so important on diesel, but it's also so important for crude as well, because Straits of Hormuz are under threat again. So it'll be very interesting to see if there's anything that happens there. I think that's a flash word potentially in the next few weeks.
Yeah, I mean, as I was saying to you guys before, the problem that I see here is that, as we said, we're back to square one, or even a worse scenario than a square one. But there's a difference, is no one wants to talk about this anymore. It's like the news outlets. Before, it was just exclusively around this, and it's sort of front page, but some sort of AI news comes up, and then it's back into the third page, and it's no longer top of mind. And you talk to traders, everyone is exhausted. Everyone is like, this was crazy. Everyone wanted to go on holiday and risk off and things like that. Probably not gasoline traders. We'll talk about that later. Now they're having the time of their lives, but I don't really see that we are anywhere close to any kind of resolution. And when we were in March and April, there was this is too big to fail, and everyone was talking about this, not just the news, but also on a political standpoint. They were all over it. They were trying to find solutions, and now it's just insults and attacks. And I think about the Ukraine situation, where everyone was like, oh, this is going to last for 2 months and that's it. And now here we are 4 or 5, 4 years later. And first of all, no one, other than us, because it affects oil and refineries and all that, but in the news or anything, no one really gives a shit about it. It's like, it is absolutely not top of mind. And we're 4 years in, what if this continues, for a longer period, because what if this lethargy that we're seeing on a diplomatic side continues? We don't really have the same bullets that we had before. But at the same time, you get to the point where you talk to people and no one wants to think about it anymore. When this whole thing started, there was a lot of also crying wolf, and we were part of it. It's like, hey, there's not going to be any jet fuel. And then, you know what? There was no problem with jet fuel, and traders and operators in the market did a phenomenal job of making sure that there was enough oil everywhere. So we're now in this environment where you're not getting the sort of societal pressure on the diplomatic side. Diplomatic side is just, insulting each other. I'm concerned about this, because this could last for much longer than we think, So that's just my 2 cents, It's just one opinion, but I find it interesting where we are right now. And again, just see the price action. Okay, when you're looking at specific products, cracks, spreads, all-time high and all that, but the main headline is Brent and 85. Okay, yeah, we went through this contango phase with all the crude cargoes moving out. I get it, that makes sense. You need to absorb all of that. But when you look at the discrepancy between the back end of the curve and what's happening on the diplomatic side, I'm very confused. Let's put it this way. It seems like we're heading into quite a difficult situation in Q3, Q4.
Yeah, so maybe to unpack that, we could try and explain why crude is so low still. Do you think on the sort of trading psychology side, there's just an unwillingness to believe it yet, because at any time there could be some kind of taco? I mean, just to learn the lessons of the last 3 months. We're now back to a pre-MOU situation where crude was also relatively low, the flat price of crude, before all the exits started happening at a rapid pace. And that's because people were fatigued, because at any time you could get the negotiations or Trump saying something else that was bearish. And there was all the talk of price manipulation, right? Every time that flat price looked like it might rise, there was some statement cooling the price, and it was impossible to trade against that. And the other thing is, one of the big solvers is China. And I think it's safe to say that there was an expectation before this whole thing blew up again that the Chinese might start to come back to the crude market. But now, if you have to make an assumption, you assume that they're not going to do it, because the flow out of Hormuz is extremely uncertain. So we're kind of back to the situation pre-MOU, where we're waiting for these solvers to run out, but it's still going to take a little while.
Yeah.
We're still got some stock to draw. Let's learn the lessons from the beginning of the conflict as well. We still got some oil inventories to draw. It's just, as you just said, it makes things look pretty grim for the end of the year. Let's put it like that.
No, I mean, if you think about trading psychology, yes, indeed, there's this element of, I remember the first day of the war, the second day, I had calls with friends, trader friends, and they were all, not necessarily crude traders, but they were all like, in their mind, I need to buy Brent. That was the go-to product that you buy in a speculative kind of, it's going to go up. And then they got punched in the face multiple times, and they're like, okay, Brent is not my ideal product, right now. But when you think about this on a fundamental basis, all of the measures, the SPRs, most of it was crude. And most of what was open when the Strait opened, what went out was crude. So we had a glut on crude, and we had contango and all that. So, and on the other side, the demand is there, and the demand is not for crude. The demand is for gasoline, diesel, etc. And that's where you put all these things together, and if you are, it just makes sense that the cracks and the spreads are just at all-time highs. I was looking at it this morning for, at least for gasoline, the highest level in 10 years. And probably, I don't know, I don't remember how it was more than 10 years ago, but it was probably the all-time highs. So at the end of the day, if you are getting to that situation where, as a lot of trading companies are saying, and EIA, etc., we're running out of stocks, the whole, hey, we're back with the same narrative, we're running out of stocks and all that. The best way to do that is to kill that problem, is to kill demand. And the only way that you do it, if you don't want to touch crude, is essentially the cracks. And that's what people are doing. Maybe not necessarily on a logical kind of, this is my mindset, this is why I'm doing it. But that's what's happening. And if you're afraid of any kind of manipulation or suppression on price, it's probably not going to happen so much on swaps, because it's much more illiquid and all that. And it's probably going to happen on futures. So maybe you see that on crude, but not as much on the product side.
Yeah, I tend to agree, and then we can talk about it later. But obviously, on the product side of things, it's not just Hormuz, right? It's the Russia situation. Yeah. And if you look at normal Russian diesel exports, those are close to 1 million barrels per day. That's actually double the problem of direct diesel flow out of Hormuz. So that's a pretty big problem that the world is going to struggle to get over. Trump can only do so much to try and cool those things. I agree.
But that's my point, is that, we have this double whammy going on, potentially a triple whammy with Houthis and Yanbu and all that. And, we started the conversation talking about the World Cup. And let's face it, the three of us are tired of talking about the same topic, and the market is tired of talking about the same topic, and people just want to go on holiday. And that is the biggest problem we have. I think that it's this exhaustion of talking about the same thing, and if you don't do something about it, then it just keeps, like any problem in life, it just keeps growing and growing, and then one day it's like, fuck, I should have done something. Excuse my French.
Yeah, I think what you said about the problem growing and growing is interesting, right? Because if we take the discussion back to diesel and the strength of what we're seeing with diesel margins, yes, it's the function of this Russian diesel ban which has come in. But I think part of it is also what we've seen with this kind of will they, won't they, when it comes to China's product exports, right? So there was this idea prevalent in the market that China's going to really expand on its product exports in July/August, and that will really add some relief into the market. And we saw spreads weaken and cracks weaken a little bit. But since all of this has resurfaced with Hormuz, that really puts that into question. And the other thing is also there's some interesting details about how those export quotas can and can't be used. So one of the things that we heard here was that any potential extra export allowance is on the condition that refiners basically need to maintain the same levels of stocks that they had at the end of February. So what that means is that if you're going to push more gasoline or diesel or jet into the market, it needs to come from procuring more crude. You can't run down on your stocks. And if crude isn't easily or cheaply available from a Chinese perspective, then that isn't as much of the silver bullet that the market was hoping it would be 2 or 3 or 4 weeks ago. So with that in mind, I think it makes sense to remain bullish diesel cracks. And going back to kind of SPR and demand being a lever, it feels more and more like, these two things have to come in some way, shape or form. Diesel prices are high, but like you said, Felipe, like Brent is only $85 a barrel. We're not where we were at the peak. And so from a flat price perspective, diesel is expensive, but it's not super, super expensive on a flat price basis. So that could mean that there still really isn't that demand destruction metric coming in yet. I think another thing also interesting to mention is on the Asia side of things, right? So since we've had the development of Hormuz attacks and the risk come up again, what we've seen on east-west with diesel is a recovery. So basically, this is the story saying that Asia is going to find it a lot more difficult to get crude, and so therefore it's going to find it a lot more difficult to produce diesel, and therefore it means it's harder to get that diesel to move westwards as well. And maybe it's also potentially that Asia's looking at it and thinking that SPR allowance is more likely to come through as well.
Yeah, there's just one more point I would add to that in terms of SPR release. I'm pretty sure that the IEA will release another batch as soon as the price gets high enough. And it goes back to my thinking that there is an element of this is still too big to fail, right? We cannot have a situation where the world doesn't have diesel. And surely the US understand that. They've admitted that some sensitivity to the fact that they can't let the world run out of oil. So something will have to give. And I think from the Chinese perspective as well, it's interesting that they don't want to export diesel. I wonder if that lasts. And on the Ukraine side as well, like who's going to put pressure on the Ukraine? Because if we're running out of diesel, there must be some pressure on them to stop quite the rate of attacks on Russian refineries. I know that it's a very difficult thing to say because it's existential for the Ukrainians and it's working really well in the Ukraine war. It is too big to fail. We can't run out of diesel and we've taken so much out of the market. It's not true. I mean, I was just writing a piece yesterday. It's basically a worst case scenario for diesel now. It just can't last. The level of demand destruction that we're talking about is probably very bad for the economy. So we'll see. It's just a high level kind of what's going to give over the next few months.
Yeah. So
because I remember when we were talking about just Hormuz being closed, we were talking about a necessary demand destruction equivalent to COVID 2020. And now we have Russian barrels as well. So it's a much worse scenario in terms of the demand destruction required. Absolutely.
Yeah. So I think with all of that in mind, it's super hard to say anything bearish on distillates. I mean, you look at what all the signs are saying on the fundamentals that we've discussed. If we look at prices, if we look at our values, all of it seems super bullish to me. The cracks are strong, spreads are strong. And if we look at our own data for arbs into Europe really doesn't have much pricing into it at that moment. Yanbu is still there. East Coast Canada, relatively minor supply, is still there. But crucially, Sika around the Cape is closed, and right now so is the US Gulf Coast. So yeah, really Europe needs to bid up more for diesel if it's going to get the supply it needs, unless there's going to be a very, very big SPR draw. I think it's important to pause on India for a second because, India's been crucial for Europe previously, but since the wars happened, really not much has flown that way. But there's a few interesting seasonal things that we need to take into account here, right? So on one hand, we've got Europe turning into winter, so winter diesel spec, and that's not very readily available. India is one of the few, and the Middle East to some extent. But there was the news that came out today that India's raised export tax. So once again, you can see the signs there that it's making it harder, not easier, to get those Indian barrels to flow into Europe. Then on the other side, if we look at what's happening with US Gulf Coast, that's really pricing to stay in LATAM at the moment. So that goes with my view that really gas oil really needs to bid up to attract those US Gulf Coast barrels away from LATAM into Europe. It's not easy to get that to happen, but I feel like that's the real lever there that's there as a solver for Europe.
What are the stocks like in PAD 3 for diesel?
Quite low. They've been recovering slightly from very, very low levels, but still not great position, and PAD 1 is still low as well. So US stocks totally are low-ish. Brazil is pulling on them, and it's still arbing to go into LATAM rather than heading into Europe. So that makes me, at least in the short term, convinced Hogo makes sense.
Okay. Neil, you agree?
On Hogo, yes. I don't think the US can be the solver that it was at the start of the conflict. So in the immediate weeks after the start of this thing, you actually saw the Hogo going negative, which allowed a lot of diesel and jet to flow into Europe. Particularly jet was a big one. Remember, there was this whole question about jet in the summer. But now I somehow doubt that it can last very long at these low levels because, as Jay said, it now needs to needs to fill the hole that Russia used to be in. Yeah, it's difficult to see a super short Hogo trade.
Yeah. So what do we do from here then? What's the solution if it's not the US?
Yeah. So then I guess it's back to the point of demand destruction, right? And prices. So If you look at ICE gasoil today, $1,100 a ton, we're still on rolling front month base. We're still $200 a ton off the peak. And if we kind of rewind the clock to when gasoil was at its peak, it was interesting to see the response from the main European diesel consumers, right? So UK, Italy, Spain, neither of them really reduced their demand that much. France was quite significant, about 15% or so year on year. But the biggest decline in demand that we saw when prices really went up was Germany. So I think it's important to touch on this a bit more, because with Germany, yes, you have the road fuel element, but you also have the heating oil element as well. So I think what happened was flat prices went up. That basically staved a lot of the one-off or seasonal buying that would take place. And that demand is not lost demand, it's delayed demand, right? So that demand needs to come back again sooner rather than later, before winter comes in. And if you overlay that with the comments I made before about the spec change into winter diesel and that tightness there, yeah, I think it is quite bullish for gasoil as we head into the winter.
I agree, particularly spreads. I mean, if you look at the front crack now, it's like plus 80. That's already done a lot. That's an incredible crack. But if you look at the front spread, it's plus 50. It's actually nowhere near where we got to at the start of the conflict. And yet the size of the problem looks to be increasing. So I think the front ICE gasoil spread is a buy, to be honest. And we just let this whole thing trickle into the physical market still.
Yeah, because these numbers are scary, especially on the crack side. It's like, to a certain extent, as we said before, in order to get to the demand destruction, you need flat price to go up. But if crude is not playing ball, then you do it through cracks. And then you get to cracks that you've never seen before. And psychologically, you're like, is this really the best trade to buy cracks at 80? I've never seen them before, etc. And you're like, well, we need to see some sort of movement or change on crude in order for that to change, because ultimately one part of the chain needs to do the job in order for you to get to a certain price on a flat price basis to kill the demand. And so, can crude be doing something about it? I don't know, maybe we can move on to crude, Neil, but can crude play a part in this or not? Or is still the crack?
On the flat price?
Yeah.
You mean?
Yeah.
Oof. It's a hard question because remember 2 weeks ago, or last week maybe, I think, no, it's 2 weeks ago, you asked me, can you get this big divergence between products and crude?
Yeah.
And my answer was, you can if there's not enough refining capacity. And that is what we have at the moment.
Yeah.
If you exclude China, if we say that China's unwilling to do much, then there's not enough refining capacity. So I still think, the margin, the indicator margins are like already plus $40 per barrel. Like anybody who can run any crude is running crude in the next few weeks because they can make mega profits. So what can crude do about it? I think on the flat price perspective, crude can do something about it incrementally. But first, we need to get to a place where we're convinced that we actually don't have enough crude as well. And for that, we probably need to draw down more inventory. Like I said, the IEA are probably going to release. I guess the Koreans and the Japanese are going to ask for more SPR. We'll probably get more SPR released from the US, although there's more and more chatter about the US SPR is not functioning properly anymore because the levels are so low. So the rate of the SPR draw might trickle down. And then there's still commercial inventory to draw. I mean, European crude inventories last time I saw were very healthy. They had enough crude. The US commercial inventory isn't that low yet. One of the reasons that the slowdown in commercial crude draws in the US happened was because their exports declined. The net exports declined 1 million barrels per day, actually peaked in May. That's something I talked about for ages. Like the US arb is going to close. That's going to make the US exports drop off. And that's the solver. And now what we're doing is we're asking the Asians to come back and buy loads more WTI because the Hormuz flow is going to close. And so the US commercial inventory is going to drop off again. It's going to accelerate the draw. It's just going to take time. I think on flat price, it's difficult to say it's going to help diesel flat price now, but I think it can do incrementally over time.
Yeah, which sort of answers the question around short-term cracks. It's like if the only solution that we see is flat price, crude is not going to be in the short term, is incrementally going to go up, but we don't expect this to have like a massive spike or on the crude side at least. Then that gives you the answer on whether cracks at 80 are still a buy or not.
Yeah.
I know it sounds crazy when you say it. It sounds crazy when you say it, but you just gave me the fundamental picture there.
Yeah, I suppose so. The unfortunate one. Yeah, so the big question on crude now is just the way the Asian crude procurement goes. And we're talking about ex-China here, because I'm going to assume China largely stays out the market. We already saw overnight, or over the last 72 hours, quite a lot of things. So there was big volumes of WTI being purchased by the Northeast Asian refiners, Japan and South Korea. That's now going to be landing in September and October. There was also more Mexican deals done, and there were comments from some of the authorities over there about the state of global crude supply chain security has deteriorated. And I think that's a precursor to say, okay, we're gonna produce more of these crude swap agreements, i.e., we're going to tap the SPR again. So I think we're back to that picture that we had pre-MOU, where the Asians are going to try and quite far ahead procure their crude via the Atlantic Basin, largely the Americas, plus the SPR, and they're going to be able to basically make things work for a while. One of the questions, particularly for the product market, is what they do in July and August and early September, because they said that they had procured enough crude, but that was on the premise that all of these very prompt spot tenders that emerged out of the Persian Gulf were going to load. And now they might not load. In fact, it looks like they won't load. So the Asians are in this little bind where, I could have to derate, I could have to run lower to save, basically to save into inventory for later in the year. Or I can run as hard as I can and get some emergency crude from SPR or something, because the margins are insane. Like, who wants to actually reduce runs right now when you can earn $50 a buck? So that's one of the key questions. We're sort of debating it internally, but it's just a slight shock, because it's like, boom, the spot crude is not happening.
Yeah, I always, when you have these kind of questions, I always go back to what Warren Buffett says, show me the incentive and I'll show you the outcome. Right now at $50, that's the outcome. You're going to maximize as much as you can. And unless there is some sort of government intervention to ration or whatever, I just, it wouldn't make a lot of sense to you not to run at this kind of margin.
Yeah. You just need the crude, and I assume they've got inventory, they've been rebuilding inventories, and certain things look quite cheap, and maybe you can get it slightly prompter, like WAF, for example. WAF looks really cheap because the WAF divs completely plummeted. $10 per barrel over the last week, the WAF divs fell.
Okay.
And so they now look cheap in Asia. You can probably get those delivered in September. So maybe that helps.
Again, what you can see is that there doesn't seem to be a crude problem right now, not a massive one at least.
No, this is more of a question for what the Asian guys do timing wise. It's just a slight, it's a large hiccup in the timing of crude procurement for the Asians. But in Europe, for example, there's still this little glut. Like I say, the WAF premiums absolutely fell off a cliff. The problem is this like triple whammy of there's no WAF moving to Asia. There's less Brazil and LATAM moving to Asia in recent weeks because Hormuz was open and the Chinese aren't buying. So you've got sort of Brazilian crude on Suez going into Europe, and you've got directly the AG sour grades that were moving into Europe as well because they had nowhere else to go. So Europe is actually pretty long crude at the moment, but I think that will turn around. So you're going to clear these AG cargoes. A lot of the length in sour crude in Europe that was going to happen next month was predicated again on these tenders loading, and now it looks like they won't out of the Middle East. Then you're likely to have some kind of clear out of WAF going to Asia because it looks very, very cheap. And then the whole thing can look very, very different in Europe very quickly. One of the last things to say on that is the state of WTI. So if you recall, 2 weeks ago, I was starting to feel a little bit short WTI-Brent for a few reasons. One was the growing political risk on Brent, one was the freight side of things, and one was the arb being very closed for TI all around the world. And maybe I definitely got a bit lucky, but the TI Brent has now widened by $3 per barrel over the last 10 days. So a massive move. And in theory, if you look at TI Afras versus 40s in Northwest Europe, TI is now open again. But the difference is that there's loads of competition. So this is a plug for our arbs radar, which is when we're looking at WTI on a basket basis in Northwest Europe. What is the relative position of WTI versus a big basket of crudes? And if you look on that basis, it actually looks expensive because CPC is so cheap, WAF is so cheap, and so there's just this big glut. So TI is actually still closed on that basis, and I think that will get very bullish for the Brent market quite soon. So TI doesn't look that expensive. It doesn't look that cheap. It's going to be cleared out to Asia. WAF's going to be cleared out. AG is no longer there. To be honest, that sounds like it's going to be bullish Brent, and that makes sense, right? How can this not be bullish eventually?
Yeah, I think the other thing, Neil, is autumn refinery maintenance, right? So all this clearing out is happening while runs may dip a little bit, and so then when they come back, all of a sudden they're dealing with a much more competitive scenario than they were a few weeks back. So yeah, again, another bullish factor for Brent.
Eventually, yeah.
So on the gasoline side, as I mentioned before, we are now at record levels on both spreads and cracks. As we were writing the script yesterday, spreads were at 65 for August, September. Now, obviously, that's outdated. Now it's 75, so $10 move or 74, $9 move in just one morning. Similar story with cracks. Let me just see, as we're speaking now, the cracks are at 36 now for August. And, obviously, as we discussed, last week we were talking about the trend is your friend. What are the indicators that could potentially mean that we need to stop this rally? And we initially looked at EBOB blending margins, E10, E5. At the time, we were close enough to open those arbs, and which would have created a sort of like a selling pressure on the market, meaning that you could blend EBOB, sell it in the market, and cap that rally. We're on E5, we're definitely far away from making that happen, and E10 we're getting closer. Actually, if I look at it right now, I looked at it because I don't remember now. On 1 second, on E10, I think we were positive for August. No, actually, it is positive now. So the blending margins are positive for July, but that July is too late. We're the games are done, and now it's August, and in August we're still far away. We're still $5 to $6 away from any kind of positive blend margin. So again, you don't have yet that selling pressure. That's the first element. Then you look at the arbs. What we see is that for August, the arbs into New York are closed. But interestingly enough, for September, October, November, they remain open for refiners. So there's a story there. It's not like a completely slam dunk kind of arb shut scenario. So it's telling you the story that the US might be pulling as we enter into that sort of August and September period. We talked about before the stocks in the US where PAD 1 are okay, PAD 3 are extremely low. And I looked at the history of arbs for August over the last 3 months, if people were buying in advance, if there was a moment of time where you could buy the August arb and lock it in, and I was looking at the history, and actually even for refiners, it was, at the best case, it was borderline open over the last 3-4 months. So the assumption here is that as you move into August or September, the arbs have been shut for New York, over the last 3-4 months. So they have not bought in advance. So you put this in the scenario. So you will, I would not be surprised if you see some comeback on the RBOB spreads relative to the EBOB spreads, as in we need that supply. Because if you look at the spreads right now, EBOB has rallied dramatically and it's much higher than it was before the MOU, whereas the RBOB spreads have not yet got back to the level they were before the MOU. So there's a potential there for a comeback on the US side that could then re-accelerate the European market and bring back, or demand more barrels from Europe. But the current scenario there is that pretty much all of the arbs are shut down right now for August from ARA. I think you have some, high reformat blending destinations like Ecuador or Colombia, but most of the main arbs are shut down, like Mexico, like Canada maybe is open, but New York, Mexico, all of that is shut down. You always have Dangote supplying as well, so your WAF demand is lower. So all of these elements are telling you that right now we're entering into the froth kind of territory. There is no need for this to go higher, okay? Because the first indicators of we don't need that much product are there. But as I said, keep an eye on New York, because we are seeing that the arbs are open for September, and no one, by looking at the ARB tool here, no one has really bought in advance for August. So you might have some sort of change of scenario. The other main thing to look at is East-West, So as we were writing this yesterday, the East-West was going back up again, The whole mental framework is Hormuz shut, less supply in the east of Suez, therefore East-West should rally. And it did, but briefly. And this morning it has gone down again to minus 16. So it went back from minus 16 to minus 13, $3 barrel moved in one day, and back to minus 16 again today. That's, again, let's not forget that there's the positioning of people, everyone was positioned already for Europe to be bullish. and Europe is the driving force right now. So we need to keep, I don't think East-West is the trade right now. At these kind of levels, I would suspect that it maybe remains a little bit choppy. You're going to have moments where we're entering into the tactical environment, for August on an East-West perspective. The bullishness has been expressed and positions have been taken in Europe and the US. So there's going to be a defense kind of mechanism there. And the question mark is very much around what happens to Singapore. Are you going to have this supply? Are you going to have the supply from China? Yes, no. We discussed about that before. If you don't have that, then you're going to see the spreads rallying in Singapore. And then you have this sort of tension between is the East stronger, is the West stronger? But I don't really think that is the trade. I think that the Singapore spreads is an interesting trade right now, given what's happening. Singapore is now the main source of supply for every kind of destination right now in the East of Suez. And unsurprisingly so, given what's happening. So Singapore spreads is for me a more interesting trade than the East-West. And as I said before, keep an eye on these Pat 1 inventories and any potential rally again on the RBOB spreads relative to the EBOB spreads. That's my takeaway right now.
So now, what about the Singapore arbs into the Atlantic? So when I was looking at the tool yesterday, I saw that Singapore was the cheapest source of supply into a bunch of LATAM destinations and also WAF. And I don't think I've ever seen that before. Do you think that's sort of not a big flow anyway, so it's kind of relevant, or?
Well, the WAF, I actually have seen this. It's actually not very uncommon to have, because again, you need to understand that the spreads sort of cancel the East-West. You don't, if the spreads are at 65, then it means that, when you load now to arrive 1 month later, you're arriving at a much lower price point, you see? So you need an East-West to be extremely low in order for that to happen. Okay, so in normal circumstances, you don't have these extremes on spreads. You don't have these extremes on East-West. So it is actually quite common to see Singapore, or let's say Far East, Korea, etc., to be supplying Mexico, to be supplying West Coast, South America. It's actually quite common. And in the past, we've also seen scenarios where AG or Singapore were open or cheaper into WAF. Now, the problem is that now WAF is less of this final destination because of Dangote, and Dangote, unless you tell me Dangote is not producing that much, which I don't think so. It's not that big of a market anyway, So yes, it's an indicator, it's a sign, but it's not impacting pricing centers. Let's say it's not impacting New York. It's not impacting the big bread and butter markets of the Gulf Coast. You would need to have like a massive shift. The Mexicans should be, instead of buying in the Gulf Coast area, they should be maximizing imports from the West Coast. Can they logistically do that? Can you say, look, because then you need to go and supply the West Coast Mexico. Then you're starting to hurt the PAT 3 and that trickles down. But again, it's not something that you will see in August. You will see that maybe as it continues, maybe in September, October, etc. So I'm not that concerned. It's like this East-West could, clearly, again, on a tactical perspective, the positioning is there and people are defending a position, this could continue going down. It all depends on, for me, the key factor is much more the supply side from China and how that affects Singapore and how then the Singapore spreads rally, and that affects the East-West as a consequence.
Mm-hmm. Yeah, okay, understood. And that will also be a function of what we hear out of North Asia, I guess, the Japanese guys, South Koreans, whether they get enough crude. That will also be, for the very short term, the discussion we had before, if they do end up derating in August or September, then I guess it's bullish Singapore, generally speaking, obviously.
So, right now, the only sort of mental barrier is this: the prices are too high. You see, you look at it, and we're already at the highest level ever on spreads, on cracks. That's the sort of point that maybe gets people a bit spooked. But and indeed that the arbs are now shutting down for August into the Atlantic Basin, etc. No, but I think we need to see a little bit more, and we need to see, I always look at the Atlantic Basin as one single region, because then you have the tension between Gulf Coast and Europe, okay? Because you will have Gulf Coast supplying now. They're the cheapest source of supply into most of the Atlantic Basin, okay, except for the West Coast LATAM. But that, you said yourself, the PAT 3 stocks are extremely low. So at some point, Europe has to come to the rescue. And then you end up with this sort of like, it's your turn, then it's my turn, and then you go up and down like that. But the reality is that I always thought about the Atlantic Basin as a single supply and, supply and demand kind of balance, because the time to go from one place to the other is max 15 days or 20 days, it's within the same time zone, if you want to call it,
Yeah.
So my point being is that, yes, right now, if you look at just the arbs from ARA, they're shut, but the supply is mostly going to come from Gulf Coast. How long can that last? Can Gulf Coast supply both the world and New York? That's the question mark. So I wouldn't be surprised if you start seeing New York then starting to pull barrels, and then then back. Then that gives that extra layer for Europe to say, "Hey, I'm back."
And also from a West-East perspective, I guess it helps that we're probably hitting peak demand now, and then we head into the winter, and it becomes more of a winter story, which is the opposite for diesel, right? Diesel's like getting more urgent, and gasoline less so.
No, and let's not forget, when you're let's say you're a hedge fund and you're trading multiple different products. I always heard, when you're in sort of winter season and there's a little story going on, or even a dramatic story going on in gasoline, they're like, yeah, boring. It's gasoline is not in some. Call me back when we're in summer. And right now we are in summer, and gasoline is the star of the show, or it should be. So you're going to have that demand. Of course, the diesel story is also very important, especially with Russia. But right now, gasoline is the product that should be of focus, on a demand perspective. I'm not giving any kind of advice on the Widowmaker. I have no idea. I'm just saying.
Where's your Widowmaker trade, Felipe?
No, I'm not sort of making a trade here on gasoline, diesel. I have no idea. But it's just on the pure gasoline perspective, the only mental barrier I have right now is this, who's crazy enough to buy, spreads at 75, etc.
Yeah, the Widowmaker is already really, really weak, by the way. Minus $150 a ton for September for EBOB ULSD. So yeah, it also becomes very tricky, doesn't it?
Anyway, stay married. Don't become a widow. And anyway, I think this wraps it up for today. Thank you very much, guys. Great show. Let's keep an eye on what's happening. You see, we're in the circumstances where we would have normally done like emergency podcast, like we did during the beginning of the war, and we're not necessarily thinking about it. We don't even have the demand for it. I go back to what I was saying before. It is dramatic, but it's, we've already seen this drama recently, so I'm used to it, kind of scenario.
I noticed it from journalists as well. The first 4 weeks of post-Iran conflict were absolutely crazy from a journalist perspective. But this week is pretty quiet, I would say. I mean, obviously an uptick in interest, but relative to back then, pretty mild.
Yeah. Anyway, thanks, guys, and I'll see you next week.
Thanks.
Cheers.